MEG Energy reported a steep drop in second quarter profit and grappling with the effects of both wildfires and falling production. Let's go to Cole Smead, CEO and portfolio manager at Smead Capital Management, to talk some more about this. Thanks for your time today.
Hey, thank you.
So net earnings, $67 million in the latest quarter versus $136 million at the same quarter last year. What led to the big drop in money coming in?
It's pretty simple. It's just the oil price that's moved around. And I think their quarter in general is as expected. They had talked about what had happened in wildfires in their business and things of that nature. So I don't think that was really the information or news anybody was looking for. I think what's more interesting is in this hostile takeover that Strathcona has gone after MEG. At first, the market was thinking that there was some other offer out there. And I think MEG traded for as much as a 13 to 15% premium relative to Strathcona's offer. And I think if you look today, that's somewhere between 6 to 8%. And so we're beginning to see this story of the market believing that there's less likelihood of another offer coming out there, and the market's starting to price that in. Now, why I think that's interesting is because I don't think what anyone's really saying is MEG is just trying to deflect and not address the fact that there is no other bids potentially out there. There was a Financial Post article that said there would be some other offers potentially coming in, and that was supposed to be coming in last Monday, which was the rumored time they were going to look at those that the Post reported on. But the stock market's beginning to see that there is no truth to that rumor. And I think what we're going to wake up is a situation, if Strathcona wakes up at $38, we're going to see MEG close this deal around $28, which would be exactly the deal terms already laid out.
Okay, so you think there might be a reconsideration of the takeover bid by Strathcona. It was, as we know, rebuffed by the board originally. What did you think at the time it was rebuffed? Did you agree with that decision by the board?
Well, let's put it this way. The history of this business is that people have always talked about it as a buyout candidate. MEG, looking back, obviously, Husky tried to go after them. What MEG is outstanding at, first off, they have an excellent asset in Christina Lake. That's a great asset, just to call a spade a spade. Now, what MEG is very successful at in its history as a business is fighting takeovers. MEG is great at fighting takeovers. Now, whether that's good for the shareholders, we shall see. And I think that's really what the market's trying to ask is, okay, great, you've made this big claim, you're at the poker table, you have a big hand. That's what MEG is claiming. And so far, the market's starting to think that maybe they don't have the hand they thought. What is the difference between MEG Go Alone versus Strathcona being the owner of their assets? It's two things. One, it's overhead costs. Two, it's executive compensation going down because you only need one CEO, you only need one CFO. And this is the arc of the industry. We're going to end up with 3 major Canadian producers in 15 years. It's going to be, Suncor is more than likely going to be there. CNQ is going to be there. Who's going to be the third? Who's going to be the fourth? Maybe potentially, but I think there's only going to be 3. We definitely know that MEG is never going to be one of those.
Okay, so let's talk about whether you think this will hold down the line. But by what I mean by that is, do you see a better match for MEG out there than Strathcona that could be possible?
No, I don't. And here's why. We own Cenovus, Strathcona, and MEG. Cenovus is cheap, and there's no one that will debate that. So Cenovus is in a position where they just came off a really good quarter. Everyone has been complaining about their downstream assets for a long time, and they actually surprised people positively in the downstream assets. What we own Cenovus for is they have incredible upstream assets, and that's really where the value of the business is. But at these prices today, and a deal that includes stock on Cenovus makes absolutely no sense. And I think that's really where the other bid theory falls apart. If you're Cenovus, you assumably would want to do stock, but their stock's too cheap, which makes it an expensive way to do a transaction. Versus, the incentives point towards Strathcona benefiting from this. I think as this deal's gone along, Strathcona is catching a bid. And again, if you go look at the deal terms, it's 0.62 Strathcona shares plus $4.10. And so if Strathcona's at $38, MEG would be valued on an arbitrage basis around $28. I think at $28, I think this is going to close pretty easily. I would have thought that earlier prices would have said Strathcona's got to pay up. And as this deal premium is starting to close and close and close to the mid-September deadline, there may be no premium, and we just may have been wrong on needing to pay up for that. And I think that comes down to maybe MEG way overplayed their hand so far. Because if you told your shareholders through the Financial Post, you leak this information to the news that you have other bids and you're going to take the bids on these days, things like that, they're doing a terrible job of communicating what's going on. And shareholders are in the dark right now. The quarterly earnings provided no communication around what's going on in that. And it seems to be there's so many bidders and there's no information. And that's going to leave people wondering a lot of questions about the leadership of MEG in this process.
Interesting. Okay, let's take a step back and have a look at the energy sector more generally. What are you doing about energy investments right now? Because there is a lot of outside noise. And I'm just wondering what investors are saying to you and what your move is at this point.
Yeah, I mean, we're coming off the second best buying opportunity of my lifetime, the last 20 years in the industry. So, I mean, here we sit today in the high 60s on WTI, and this is a place that all the experts and all the brilliant people that come on your show would say there's no way we're going to have these prices because, you know, OPEC Plus is going to ruin this market. And there's a bunch of industry people and investors that have egg on their face because ultimately oil is a great way to espouse dour views of the future. And the reality is the future is very bright, and the great part is we're proving today that the shale game is cooked. Frac crews and rig counts there are going off of a cliff, and what I think people are missing is that between that change on the supply side, plus demand being a lot stronger than people thought. You know, if you look at the TSA numbers in America, for example, we just bumped along the all-time highs in traveler data in America. Jet fuel is a primary source of demand. So demand continues to be stronger than people expected because ultimately the future is bright for humanity. And it's just that everyone had great near-term views of how bad the economy was going to be in places like the United States. And so far, that has been just absolute baloney.
Okay, so where are you advising your investors to go? Are you advising them then to go sort of with a mix of energy at this point, or are you saying, you know, let's keep it in oil?
Yeah, there's been way too much confidence in the gas markets, and not to say that like gas is some bad place to be invested. We just don't own any, you know, pure gas players because when April showed up, everybody got scared of the oil business. So they all, you know, they had to go somewhere in the space. So where did they go? They went to nat gas, and they felt really bullish about nat gas. And what's done is people were paying too much premium for nat gas assets relative to oil. I think that's why the Strathcona transaction was so interesting because they sold their Montney gas assets to buy MEG, which was a heavy oil asset. It was a great arbitrage. Fast forward to today, watch Tourmaline go down. Mike Rose was doing stock deals with Adam Watrous on the Montney assets. Why was he doing stock deals? Because he didn't want to pay cash prices for those assets. And so the market's waking up to find out marginally they were overpaying for nat gas. That's what we've been seeing in the interim. And people have been making money ever since everyone got scared in oil. And so I think that's where we really sit. I mean, people want to talk about AI and the CapEx spend and all that stuff. The American tech companies are not making economic profits off of AI. The real risk for nat gas is if that plays out over 30 years rather than the next 5 to 10 like people are betting, that will slow the ideas and dreams of nat gas growth. Now, long term, nat gas will grow. I just say it because people got a little too excited about nat gas in the medium term, and they're getting their ears pinned back right now.
Yeah, so the growth might take some time to come around.